Welcome to the Opening Bell Report.
All right, let's talk about that sinking feeling. You know the one.
Oh, yeah.
You've been watching a stock, maybe you're even up on it, feeling like a genius. You think you've finally cracked the code.
Mm-hmm.
It is January 23rd, 2026. You open your portfolio app expecting to see green, and instead you see a crater. Navitas Semiconductor, ticker NVTS, down nearly 10% in a single session. Closed at what, 10.17?
It was ugly.
Yeah.
There's just no sugarcoating a double-digit drop like that. Wakes you up pretty fast.
It's brutal. But here's the thing that I think is driving everyone crazy right now. Just a month ago, literally weeks, this stock was the absolute darling of the semiconductor space.
It was on fire.
It rallied 47%. It looked like it was heading to the moon. And then, snap. It gives a huge chunk of it back in a blink.
Yeah.
So naturally, the inbox is flooded. People are asking, is the party over? Was that rally just a fake out? Or, and this is the big question we're digging into, is this actually the sale of the century?
It is the definition of a battleground stock. When you see that kind of whiplash up nearly 50%, down 10%, it just means the market is having a violent disagreement about what this company is actually worth.
And with Navitas, it seems like nobody really knows.
Well, frankly, nobody knows exactly how to price it because the company you see today isn't the company they promised to be tomorrow.
Right. So that is our mission for this deep dive. We're not just going to stare at the red chart and panic. We've got a fresh post-correction analysis report. It's dated January 24th, 2026.
Mm-hmm.
We are going to tear apart the technicals, the financials, which I've had a peek at, and they are absolutely terrifying.
There's something else.
And the sentiment on the street. We need to answer one question. Is NVTS a trap, or is it a rocket ship sitting on the launch pad just waiting for a match?
To answer that, we have to start with the autopsy of the crash itself. Why did it drop on January 23rd?
Yeah, what happened?
Because if you look at the filings, and the report makes this very clear, Navitas didn't actually do anything wrong that day.
That is the weird part. No earnings miss, no CEO scandal, silence from the company, so why the nosedive?
Exactly. This was a classic sympathy move. The villain of the story was actually Intel. Intel gave weak guidance, the market panicked about the entire semiconductor sector, and the algorithms just hit sell on everything related to chips. It's the old logic. When the elephant sneezes,
the mice get trampled.
And Navitas is a mouse in this scenario.
But it got trampled harder than most. I mean, why did it drop 10% when the broader index only dropped a fraction of that? Why so sensitive?
That comes down to beta. For listeners who don't track that metric closely, beta essentially measures how volatile a stock is compared to the overall market.
And Navitas is?
Navitas is a high beta stock. It's essentially a leverage bet. When the semiconductor index goes up 1%, Navitas might go up 3%. But
when the sector goes down 1%, Navitas crashes 3%.
It amplifies everything. It's high octane.
So it's a drama queen. It feels everything more intensely than the boring blue chips.
That is a very accurate way to put it. But we do need some perspective here. The report highlights that even after this 10% nosedive, if you zoom out to the 2024 lows, the stock is still up about 200%.
That is a wild stat. So if you bought in 2024, you're still popping champagne. If you bought last week, you're crying?
Context is everything. The report notes that technically the stock was overbought.
Right.
The RSI, or Relative Strength Index, was just screaming that the price had moved too far too fast. It needed to cool off.
So this drop, as painful as it is actually healthy.
It's a reset. The engine was overheating.
Okay, so we have a volatile stock taking a breather. But let's get into the actual business, because this isn't just a standard chip company. The analysis report calls Navitas a call option on the future of AI.
It's a heavy title.
What does that actually mean?
It is a massive claim. A call option basically means you aren't paying for what the asset is worth today. You're paying for the potential of what it might be worth later.
So it's pure speculation.
Purely speculative play. And the reason it's so speculative is that Navitas is currently in the middle of, well, they're burning the ships.
I love this part of the narrative. It feels incredibly risky, almost cinematic. Walk us through this pivot, because a couple of years ago, I knew Navitas as the charger guys.
Right. If you looked at them in 2024, 2025, they made chips for mobile phone chargers. You know those fast bricks that charge your phone in 20 minutes?
Yeah, that was them.
That was Navitas. It's a fine business. They were good at it, but it's a commodity.
Mm-hmm.
Margins are low. Competition is everywhere. You're fighting for pennies against these massive competitors.
And now, in 2026, they've basically looked at that business and said,
we are done with the pennies.
They're going all in.
They are trying to execute a complete metamorphosis into an AI data center power company. They want to power the servers that run the big AI models, like ChatGPT and Gemini. But to do that, they are intentionally killing off their old revenue streams. The report calls it intentional contraction. They are walking away from the mobile market to go all in on these Heimdallhen AI chips.
But the transition, I mean, looking at these numbers, ugly feels like an understatement. It looks like a disaster zone.
It's gruesome. Revenue is down roughly 53% year over year. In the trailing 12 months, they only brought in about $57 million.
That's tiny.
For a public company in the semi-space, that's almost a rounding error for the big guys.
Imagine being the CEO on that earnings call. Great news, everyone. Our sales are half what they used to be. That is a tough sell.
It takes a massive amount of conviction to do that. But their thesis is based on physics. They believe that legacy silicon chips, the stuff we've used for 50 years, have hit a wall.
How so?
They simply cannot handle the heat and voltage required by modern AI data centers.
Okay, let's pause on the tech for a second. We hear GaN thrown around a lot, gallium nitride. Why is this better than silicon? Is it just a buzzword or is there real science here?
No, it's chemistry. Think of a semiconductor like a highway for electrons. Silicon is a decent highway, but it has a speed limit.
Right.
If you push too much power through it, it gets hot.
Correct.
Extremely hot. In a data center, heat is the enemy. You have to spend millions of dollars on air conditioning and liquid cooling just to stop the chips from melting.
So the more power you use for AI training, the more you waste on just keeping the room cold.
Exactly. It's incredibly inefficient. GaN is a wide bandgap material. Without getting too nerdy, it means it can handle much higher voltages and switch much faster than silicon without generating nearly as much heat.
So it's an upgrade.
It's like upgrading from a gravel road to a maglev track. NVTS is pitching GaN as the only way data centers can keep scaling without causing an energy crisis.
So the pitch is, we are shrinking today so we can be the standard bearer for the entire AI power grid tomorrow.
That is the dream. But as investors, we have to live in reality. And the reality is the bridge between now and tomorrow.
And that bridge is looking very, very shaky. So let's look at the financials. We said revenue is down. But usually tech companies lose money to grow. These guys are losing money while shrinking. The report mentions an operating margin of negative 181%.
Yeah. Let that sink in for a moment.
Negative 181%. I had to read that twice.
That means for every $1 of product they sell, it costs them nearly $2.81 to run the company.
So they're spending almost 3 times what they bring in.
Operationally, they're bleeding out. Net income is a loss of about $125 million.
Okay, so if I'm a value investor, I'm running for the hills, I'm closing the browser.
Right.
But usually when a company is in this kind of shape, losing money, shrinking revenue, the stock is cheap. It's in the bargain bin.
Yeah.
Is NVTS cheap?
And this is the part that blows my mind. This is where the bears, the pessimists, start screaming.
Uh-oh.
NVTS is not cheap. In fact, the report calls it valuation insanity.
Insanity. That's strong language for an analyst report.
The stock trades at a price-to-sales ratio of about 41x.
41 times sales. Okay, give us a benchmark. Who else trades at that level?
Nobody's saying. To put that in context, look at NVIDIA, the king of AI.
The ultimate growth story.
At the absolute peak of its hype cycle, when everyone on Earth was buying it, NVIDIA was trading around 35x sales.
Wait. You are telling me the market is paying more for $1 of sales from this shrinking, money-losing company than they paid for NVIDIA at its absolute peak?
Yes, that is the premium.
That doesn't make any sense on paper.
It makes sense if you believe the denominator, the sales number, is wrong.
Meaning?
Investors are betting that the $57 million in revenue today is artificially low because of the pivot. They think it'll be $500 million or $1 billion in 2 years. They're pricing in the future growth today.
So you're paying a Lamborghini price for a car that is currently up on blocks in the garage.
And you're hoping the mechanic actually knows how to put the engine in.
Speaking of the mechanic, how much cash do they have to fix this car? Because if you're losing $125 million a year, you need a deep bank account.
They have about $150 million in cash on hand.
Oof. Is that enough?
You can do the math. That's the runway risk.
Yeah.
They have a little over a year of cash left at this burn rate.
And that leads to?
The biggest fear in the report. A dilution event in late 2026.
Define that for us. Why is dilution the boogeyman here?
If they run out of cash, they can't just close the doors. They will issue more stock to raise money.
And when they dump more shares onto the market?
The shares you own become a smaller slice of the pie. Their value drops. It's the classic trap for these high-growth transition stories. You might be right about the tech, but you get wiped out by the financing.
Okay, I want to play devil's advocate. We have a company destroying its own revenue. It's losing massive amounts of money. It's more expensive than NVIDIA. And it might dilute us in a year.
It's a rough picture.
Why on earth are we even talking about this? Why isn't this stock zero? Why are people buying it?
Because of the rocket fuel.
Okay, I'm listening. Where's the fuel coming from?
There is a statistic in this report that completely flips the script. It's the short interest.
Okay.
Currently, about 32% of the float is sold short.
32%.
That is exceptionally high. Normal short interest might be, what, 3 or 5%? Anything over 20 is considered extremely high.
So at 32%.
It means 1 out of every 3 tradable shares has been borrowed and sold by someone, betting the price will crash.
So the negativity is already priced in. Everyone knows the financials are bad, so they've piled in to bet against it.
Exactly. And that creates a powder keg. Short sellers eventually have to buy the stock back to close their positions and take their profit. If NVTS stays flat, they're fine. But if NVTS releases one piece of genuinely good news,
The short squeeze.
the shorts get scared. They rush to buy to cut their losses. That buying drives the price up. Seeing the price go up scares the other shorts, so they buy. It becomes a frantic feedback loop.
We saw it with GameStop. We saw it with Tesla.
When 32% of the float tries to fit through the exit door at the same time, the price explodes.
So what's the spark? What's the news that lights the fuse?
The report is very specific here. The holy grail for NVTS is a partnership announcement with a hyperscaler.
We're talking the big boys.
Google, Amazon, AWS, Microsoft Azure. Right now, NVTS is testing their chips in these data centers.
So if they get a deal,
If they announce a confirmed design win, if Amazon comes out and says, we are switching our server power supplies to NVTS GaN, the game is over.
the stock doubles overnight.
Easily. The fundamentals won't matter, the negative margin won't matter, the shorts will be forced to cover, and the momentum algorithms will pile in. That is the bull case. You aren't investing in the current financials, you're betting on that press release.
So it is a high-stakes game of chicken. The bears are betting the cash runs out before the press release comes.
And the bulls are betting the tech wins a contract before the bank account hits zero.
Perfectly summarized.
And if that AI thesis holds, the report suggests a price target of $20 or more is possible by 2027. That's 100% upside from here.
But you have to survive the valley of death in 2026 to get there.
Exactly.
Let's help our listeners navigate that valley. Let's look at the charts. For the technical traders who don't care about GaN or hyperscalers and just look at lines on a screen, where are the lines in the sand?
Okay, so we closed at 1017. The most critical number right now is $10 flat.
The psychological floor.
Humans love round numbers. $10 is a mental fortress. The bulls have to defend this level. If the stock dips below $10, it triggers a lot of automatic sell orders.
And if that floor breaks, how far down does the elevator go?
The report warns of a gap fill. There's a gap in the chart down to the 50-day moving average, which is sitting around 860.
So if we lose $10...
We likely flush down to 860 very quickly. That's another 15% drop.
Okay, so don't catch the falling knife if it breaks 10. What about the upside? If the squeeze starts, what's the ceiling?
Resistance is at 1130. The stock tried to get above that level recently and failed. It bonked its head and fell back down. That is the ceiling.
So we are trapped in a box, floor at 10, ceiling at 1130.
It's a coil winding up.
Yeah.
If we get a catalyst, maybe a rumor, maybe just market sentiment, shifting back to a risk on, and it breaks 1130 with heavy volume.
Yeah.
That is the trigger.
That's when the shorts start sweating. This leads us to the verdict. The report does something I really appreciate. It doesn't just give a generic buy or sell rating. It splits the advice based on who you are.
Right, the split decision. Because this stock serves two very different masters right now.
So let's role play. Let's say I'm a trader. I drink 5 coffees a day. I have 6 monitors. I love volatility. I'm looking for action. What's the verdict for me?
For the trader, the answer is yes.
Buy the crash.
Buy the crash, but be disciplined. The $10 level offers incredible risk reward. You can buy here at 1017, set a tight stop loss at, say, 990.
And if it breaks, you get out.
You get out with a tiny loss. But if it holds and bounces back to the top of the range at $13, you've made a great return.
You aren't marrying the stock. You don't care about the negative margins.
Not at all. You're playing the psychology, the bounce, and the squeeze potential. It's a purely tactical trade.
Okay, now switch hats. I'm an investor. I'm managing my retirement account. I want to buy a company, hold it for 3 years, and not have a heart attack every time I check the price.
For the investor, the answer is wait.
Hands in pockets.
Do not touch it yet. The report has a dead money warning for you.
Explain dead money. That sounds awful.
It means the stock might just chop around sideways or slowly drift lower for a long time. Remember, the real AI revenue, the stuff that justifies that 41x valuation, won't show up on the books until 2027.
We're in January 2026.
That's 12 months of waiting for proof.
And during those 12 months, you have the dilution risk we talked about. You have 3 more scary earnings reports.
Exactly. Why buy now at 1017? The report notes that the average analyst price target, what the pros think it's actually worth right now, is around 844.
So it's trading above what they think it's worth.
The stock is currently trading above what the fundamental analysts think it's worth.
That is a key insight. The hype is keeping the price up, not the math.
So if you're a long-term investor, patience is your best friend. Wait for the hype to die down. Wait for that dilution scare to actually happen. You might get a chance to buy this company at $8 or $7. Why pay a premium to wait?
So the traders are trying to catch the falling knife because it might bounce, and the investors are waiting for it to hit the floor, stop rolling, and settle.
That's a great analogy. It really depends on your time horizon and your stomach for volatility.
This has been such a fascinating look at a company in metamorphosis. We cover a lot of companies on this deep dive, but it's rare you see one intentionally destroy half its revenue to chase a bigger dream.
It's the classic innovator's dilemma playing out in real time. To build the future, sometimes you have to dismantle the past.
But dismantling the past is messy.
It's expensive, and it scares the hell out of shareholders.
So to recap for our listeners, NVTS is down but not out. It's a battleground. You have ugly financials versus a beautiful narrative.
You have massive cash burn versus massive short interest. And you have a technical setup right at that $10 line that demands attention.
Whether you're a bull or a bear.
You cannot ignore this stock right now.
It's expensive, it's risky, but if that squeeze hits, it could be the trade of the year.
Or the trap of the year.
Or the trap of the year. That is the beauty of the market. Before we sign off, I want to leave you with one thought that stood out to me from the analysis.
Yeah.
We talked about how the market is valuing this shrinking company more aggressively than NVIDIA at its peak. It seems irrational, right?
On paper, completely irrational.
But consider this. Is the market just being crazy, or does the market know something about physics that the spreadsheets don't? Does the market know that silicon has reached its limit, and that GON is literally the only way to keep the lights on in the AI future? If that's true. If they really are the only game in town for the next generation of power, then maybe 41 times sales is a bargain.
That is the multi-billion-dollar question, and we won't know the answer for another 12 months.
Keep your eyes on that $10 line, everyone. Thanks for listening.
Don't forget to like, share, and subscribe for more.